whenever someone's saying like a stock is overvalued, they might as well be saying it's cute.
Right.
It's wildly subjective. It's cute.
It's wildly subjective.
What's cute to you may not necessarily be cute to me, but knock yourself out.
And you really have to look at the incentives of the people that are saying it. Welcome to the Rich and Regular podcast, where we explore life at the intersection of money. I'm Kirsten.
And I'm Julian. And today we're talking about what it means when people say a stock is overvalued. There's been a lot of talk about that stuff. And so we're going to try to explain it, break it down so that it is, what is it? Forever broken?
Yes, forever and consistently.
Forever and consistently.
Broke.
Ooh, I'm getting old. First, I want to give a shout out to Diggy Dog 2. Who left a 5-star review that said, real people doing the real work. I appreciate that. I came upon your podcast after watching a YouTube video with the both of you in Household Fi on the Choose Fi channel. I had to look up Household Fi because I was thinking about somebody else and I was thrown off with the Choose Fi comment, but I remember when we did that. Remember that? Yeah, that was really cool.
It was.
It came across my feed even though it was 3 years old, which is true. Content is still relatable. I just listened to your episodes on brokerage accounts and ADHD. I really appreciated the info about brokerage accounts in terms I could understand. Kirsten, thank you so much for being brave and vulnerable to share on the ADHD episode. I can relate to everything you said. I look forward to diving into more shows on your podcast.
Oh, thank you, Diggy Dog.
Appreciate that.
Diggy Dog 2. I wonder if there's a Diggy Dog 1. Like the OG Diggy Dog.
There gotta be a Diggy Dog 1. He tried to be the OG Diggy Dog, and you know.
Could be a she.
Oh,
they.
You're right. Might be a they. You never know. But we appreciate you either way. I also want to give a shout out to a couple of people. I apologize for the delayed intro here. I want to give a shout out to Cody. Cody is who was a video producer. We just came back from New Orleans, and I'm pretty sure that was the longest we've ever been in New Orleans, other than when we got married. But we just came back from New Orleans. We had 2 speaking engagements there, and so shout out to any of our new listeners or viewers who we may have met in New Orleans at Hospitality Hued or at the 4PXP conference. We had a great time at both of those. But Cody was actually the video producer at 4PXP. We met him last year. This was our second year doing the 4PXP. And he shared with us, like, he threw it in there real quick and I almost got teary-eyed because whenever this happens, I was like, oh, man. But he basically said, man, when I met y'all last year, that's when I really started investing. And like, honestly, like, we talk about ratings and reviews and all that stuff, like, but that's all I really want out of life, man.
That's it.
That's really it. I just wanted to be able to like meet as many people and to have them say that to me and like thank me. And not like I'm doing it for me, but like I just want to know that, hey man, I heard this episode. I heard this thing that you said. It made me go and look. And lo and behold, I was like, man, I'm going to keep on rolling with it. Yeah. And that's all I really ever wanted, man. So shout out to Cody and all of the first timers out there who may have been influenced by something that we've done or created over the last couple of years.
Yeah, I think this might be another influential type episode because I feel like we do these kinds of episodes every couple months because people need the reminder of what index and chill like really means and why we do it and why we believe in it. So I don't know if this is going to be a short episode because at this point, it makes so much sense to us. Or if it'll be longer because we're explaining, I don't know. But
I would like to keep it short. And I say that because that's just sort of where I am emotionally. And I'm just finding greater value in being brief because I know I can go on. I can just keep on going. But I want to make sure that we keep it brief. And so with that said, why don't we go ahead and start talking about the particular topic?
Yes.
Stocks and overvaluation. Yes. What does that mean?
The whole point of this is to break down what it means to be investing while stocks are quote unquote overvalued. And if you are not watching us on YouTube, every time I say overvalued, I'm probably going to use air quotes because there's been some market volatility lately. There's been some drops and some bounce backs, which means that people just get louder and louder about their presumed psychic abilities. And so I'll just break down what happened last week. Long story short, the new jobs report came out in the US, and it showed that employers had slowed their hiring more than what economists were expecting.
Mm-hmm.
And so it just kind of threw everybody off guard. It threw the financial analysts off guard.
What does this mean?
Now, anybody who's been hunting for a job knows that this is true. We know that companies have been slowing in their hiring. Like, that's all everybody's talking about on LinkedIn, on Twitter, on Facebook, at happy hours. Like, yeah, the economy is slowing down, but it finally showed up in the reports, lo and behold. And so everybody just kind of panicked. It was the straw that broke the camel's back. So in order to understand that, you also got to understand what came before it. Now, for the past month or so, big tech, the Magnificent Seven. If you've been listening to this podcast all year, you know we've already talked about the Magnificent Seven, how they've been carrying the stock market. Their momentum took a turn about a month ago because investors got worried that the expectations for future growth were just a little too optimistic. There was speculation about the AI bubble, and then there were all these profit reports that were kind of underwhelming. And so when the updates from Tesla and Alphabet came in, it just added to this pessimism. And then Apple dropped 5% because Warren Buffett had offloaded his shares with Berkshire Hathaway. And then Nvidia, which is the AI darling, drops 9% because some report said their new AI chip is delayed. Now, by dropping 9%, that just means that their year-to-date gains shrunk from 170% to this mere mortal 97%. Like, they're still... they're still way, way up, but they're not like close to 200%. They're closer to 100%.
Yeah.
So then the global market started doing things, playing follow the leader. There were all this talk about a recession. Japan had its worst day since the 80s. Everybody's freaking out until the next day. The next day, people woke up to markets back in the green. And if you had not panicked that week, you would have ended the week up.
Yeah. Yeah, so this is what I mean by I really want to be brief because I am legitimately embracing like my uncle old man energy. And I have been through this like more times than I can count. Like, and it's funny because I remember just saying that about New Orleans. I was like, man, I've officially reached the point where I don't know how many times I've been here, right? Like, it's one of those cities that's in my back pocket where it's like, yeah, I've been here. I've seen the growth and development. And listen, I could do a whole podcast about New Orleans and what has happened over the last 20 years, right? But it's the same thing with this, right? Like, I'm 44, is that right?
Mm-hmm.
44 years old. I've been like really paying attention to money and investing for at least 20 years now. And at certain points, you just like, yeah, I mean, you know, balls bounce. The sun is hot, water is wet. You know what I mean? Like, yeah, this is what happens. But I found myself a little bit more annoyed this time. And it's not the stock market's fault or like financial media's fault, even though I like am very quick to like point the finger at the financial media because like I feel like we're so bored. Like it felt so childish this time around because this was like such a tickle of a warning sign. You know what I mean? Like to me, like there was not nearly enough substantial like evidence or even like the beginnings of a trend to warrant the kind of reaction that we had. And it felt like it was more so tied to just like the political environment that we're in and like this sort of like fighting for attention, right? Like
they're competing against the Olympics.
Exactly. That's what it felt like. It felt like, hey, no one's paying attention to the stock market. Let's give them a reason to care because everyone's paying attention to the Olympics or Trump versus Kamala. And like, that's not fair. And so let's like pour as much gasoline as we can over this thing. And of course, to your point, like it bounces back. You can't fake it. And now it's like all the articles that you read, all the segments that you did, you look absolutely ridiculous. And I guess it is safe to say I kind of have beef because we talked about this even in like our class, like quick plug for Making Money Grow and shout out to everybody that's in that community and took the class. But like we do take shots at financial media because I think all of this to say like this is a really important part of being an experienced investor. So when people say like experience is the best teacher, this is what they mean. I can tell you that markets bounce back, but like you have to go through it 5, 6, 7 times. You have to, it's like being a parent. You have to sit there and watch a child and you see them crying. And if you don't have a child, because I've been that person, I've looked at them like, you're not going to get this baby. But the parents who know that child, like, man, he's fine.
Right.
I know that cry. He'll be, give him 4 minutes. He'll be fine. Just put some headphones on. He'll be all right. You know? And so all of that to say like that to me is what this felt like. It was like a really, really big overreaction. And of course, the idea of certain stocks being overvalued because they were dipped. Like, to a certain extent, I think there is some truth to that matter, especially, I will say I was happy to hear about like the AI bubble, right? Like it's pretty safe to say that like, we've really been riding that wave for a long time now.
Sure.
And so I was happy to hear that part. But yeah, I just sort of felt like there was a lot going on. And so my hope, or our hope with this podcast, is to kind of help people kind of get to that stage a little bit. Like that's what Big Cuz is supposed to do for you. It's like, look, man, when you hear this is what this means.
Right.
Don't overreact to it unless you are a day trader or,
Absolutely.
trading stock options. And like, that's where you make your bread and butter. But if you are a traditional employee or even an entrepreneur, you're a long-term investor, like you really don't need to react to these things. I'll tell you when you need to react.
Yeah.
But this is probably one of those examples where you should pay attention so that you know what to ignore the next time you see the financial media kicking and screaming like a 5-year-old.
And a lot of that noise does come from short-term traders. A lot of it comes from retail
100%.
investors who use investing for cash flow
Yes.
versus using investing for long-term growth.
Yes.
And you have to know which one you are to know what you should tune out and what you should react to. At the end of the day, there is a label for all of these types of market movements. We talk about this in Making Money Grow. There's a difference between a market correction, a depression, and a recession.
That was the other thing.
Oh, I know. People were already...
Yeah, I'm sorry. Because I heard that. I think I don't know if you remember this. I literally just turned off the television.
Yes.
Because we were in a hotel. We don't normally, watch this stuff. The news just happened to be on. And somebody threw out the word depression. I was like, come on, bro.
Now.
Really?
Come on now.
Like now we're just playing with the word, just getting people riled up for no reason. It's wildly irresponsible.
But this is where we are when there's so many retail investors and there's no real consequence for saying whatever you want, even though it has the ability to swing markets. Now, hedge funds, long-term investors have gotten savvier over the years. And now we know that when short-term traders start pulling their money out and things start to dip, to take advantage of it, which is, I think, how the market recovered so quickly. But that's all just speculation, which is the point. Like whenever there is a market correction, which is a short-term dip, stock valuation is typically at the core of it, which is why we wanted to talk about this topic. Like, what does it mean to invest when a stock is overvalued? What does that mean for you and your money? And the short answer is nothing, because corrections are completely normal and they happen all of the time. But I do want to explain it.
Yeah.
So let's just start with the explainer. Y'all already know when you own a stock, you own a piece of the company. So when someone says that the stock is overvalued, that means that the price of the piece that you own is higher than its actual worth based on its current performance and whatever they think is going to happen in the future.
Yeah.
None of us know exactly what's going to happen in the future. Obviously, insiders have a better idea of what's going to happen in the future. But for the most part, it's a mix of what they've done, what they're doing currently, and what they're going to do in the future. An overvalued stock is like paying $500 for a $100 bill. It's still a $100 bill, but you paid $500 for it. You overpaid for it.
Yeah.
And I think a prime example in this space is when everybody was hyping up the meme stocks. Y'all remember meme stocks? It was stocks that went viral, and they had all of this community and sentiment behind it because it was a quick way to get some cash, get in, cash out, a pump and dump, as they call it. But it wasn't necessarily based on any strong fundamentals of the company.
No,
it was
vibes.
Simply based on the sheer energy.
A collective gut feeling.
A collective gut feel. And in the investing world, they call that market sentiment. Market sentiment can drive a valuation up or down, regardless of what's happening. When we talk about the AI bubble, quote unquote, it's because the market sentiment was so excited about AI and its possibilities. Now, when it comes to meme stocks, a lot of that is driven by one or two, gamblers on Reddit, one or two community leaders with big podcasts. And a lot of people end up losing money on that stuff because they have it locked up, waiting for it to rise again, or they just got caught up in the hype and they missed the opportunity to sell. Last week, a lot of the brokerages were down.
Yep.
So if you needed to get out of something on Monday or whatever day it was, you couldn't log into Vanguard, Robinhood, none of them. You just couldn't do it. And that is the risk that you take when you play that game.
Yeah. Yeah. I just think that there's this huge disconnect between valuation and like the reality of the business environment or the company environment. And to your point, a lot of it is fueled by hedge funds and this new influx of retail traders, which kind of makes sense, right? You've got this new cohort of people who don't have a lot of experience. They also do have a good bit of wins under their belt, right?
And they got big audiences
And all of those things. And so I think it's certainly something that we are starting to see have a reflect on how the news is reported. Because since there is so much movement with these retail traders, like that sets the tone, I think, for the news, which is unfortunate because if you're a newbie and you're a long-term investor, you feel like I should know what this is. And it's not even really for you, right?
No.
It's not like they say, hey, if you're a long-term investor, this isn't important, turn this off. They just put it out there and they say, hey, this is something to be mindful of. This is something that we think might happen. And as a result, you as a long-term investor, right, which the vast majority of people are, can look into that and start making, certain kinds of decisions. And we see it all the time. Every time we ever get into like a group discussion, like a family or friends outing, you hear people say, well, I saw on CNBC. And I was like, yeah, but like, why would you react to anything that you saw on CNBC or any news media channel for that matter, right? So all of that to say, there's just a huge disconnect going on. Now, when we are talking about an actual valuation, right? Like to me, there's a bit of an art and a science of this. So when we're talking about stock market valuation, you're really just talking about the total value of outstanding shares for that particular company. But then there's like the reality of the company, which is what they're actually generating in revenue, what then gets trickled down into profit, and the actual health of the company, their ability to do that consistently over time. But even that is just one tiny bit of what you should be looking at when it comes to trying to determine whether or not a company's ability to do that for a certain period of time is good, bad, predictable, etc. Right? And so you've got the what may be happening in the industry.
Mm-hmm.
So is that company one of the leaders? Are they, let's say, number 3 in their industry? You've got, in some cases, legislative issues that might have an impact on what the potential growth of that company is. It could be climate change. It could be like, you could think back to the pandemic.
Yeah, a global event.
A global event, right? Some black swan global event thing happens and all of a sudden healthcare stocks or pharmaceutical stocks go through the roof because people understand that there's going to be a bunch of money flowing in from government into these companies, and they basically have an agreed upon monopoly for the betterment of the world for a short period of time. So yeah, you can make some pretty good assumptions that for a short period of time, you're going to anticipate some growth or see some movement for those particular stocks. And so all of that to say, like, these things happen, but I think we just have to be mindful that, like, more often than not, this is information that is more relevant for traders and not long-term investors. I think another maybe softer example, and I was doing a little bit of research on this because I was thinking about Apple, and I remember, they were pretty late to the AI party. Right. But because they're Apple, they're going to get a disproportionate share of the attention from the media. And so then they launched Vision Pro. And I remember that because I bought the old version of the virtual reality headset from Facebook, which was then called the Oculus Quest. And so I was particularly interested in this because I was like, wow, let's see what Apple does. I mean, they're such a big, powerful company. And it was interesting. And as I was paying attention to the general mood and not necessarily the market sentiment, but like what people were actually saying about it, it was kind of mixed. And I was like, oh, well, that's unfortunate. But all of that to say, when they do their conference, and I don't know how many times they do it a year, I think it maybe is like twice, the WWDC conference. After this particular event, because it was such a wow event, and it was like revolutionary, like it was great marketing too.
We were very excited.
It was very exciting. They saw positive movement in their stock, right?
Yeah.
But that hype went away. And I was reading this article on Nasdaq.com, and they were saying like, yeah, there's a pretty high return rate. Like people are saying like, yeah, I bought it, but I don't like it. I don't want to keep it. It's too heavy, blah, blah, blah. And so all of these things kind of deflated the value of the company. And so you can literally see, like, after earnings reports, after sales reports, all of these things, you can see like it was hyped upon its intro. And then there was a big dip after, let's say, second quarter earnings or something like that. I don't know the details, but there are numbers behind it. And then at the end of the article, they were saying they were anticipating future sales after like a re-release. And it was like some wild number. Like it was almost like twice what they had originally sold. And I was like, see, this is what I mean. You know what I mean? It's like, so they launched something. It's very clear. Like there's hard data that says, yeah, it was kind of a miss. Let's just be honest about it. But then they're like, yeah, but the second one, is going to be bomb. And I was like, you mean like the iPad 2?
Right.
Like, come on. None of these things were like really that great or revolutionary. They weren't the iPhone or the iPod, you know?
Yeah.
And so all of that to say, right? Like it's just hype. It's a lot of it is hype. And I think the job for a lot of investors, which I'm willing to bet 99% of our listeners and viewers are just regular long-term investors. Few entrepreneurs out there and a good group of hardworking folks. I don't think you really need to be paying attention to this. And so whenever someone's saying like a stock is overvalued, they might as well be saying it's cute.
Right.
It's wildly subjective. It's cute.
It's
All right,
wildly
well,
subjective.
what's cute to you may not necessarily be cute to me, but knock yourself out.
And you really have to look at the incentives of the people that are saying it, which is something that we believe at our core. The world is run by incentives. Even Charlie Munger, may he rest in peace, said, if you want to predict outcomes, you need to look at the incentives, something like that. I'm paraphrasing. But it's very true. When you're talking about the incentives for short-term traders, they need movement.
Yes.
They have to have movement
That's
in order
they make a living.
to make a living. When you look at the incentive of people on television, they need your attention. So they have to describe the stocks as tumbling and crashing, even though it's only 3% down from the index. And obviously there's some more volatility depending on whether you own individual stocks or not. But a lot of this language, a lot of this talk and energy is because of the incentives that people have, which are not necessarily aligned to yours.
Yeah.
That's why it's so important to establish your own investing philosophy and figure out what your own risk tolerance is, because you either saw that as a buying opportunity, just like everybody's been having back to school sales and tax-free weekends. You saw that as an opportunity to like cash in on a quick little discount, or you saw it as an opportunity to get out and cut the loss and then you miss out on the gains. And so I feel like there's a lot of parallels to the housing market right now. Even when you look at home prices, they're not just based on like the materials that it took for to build the house and like the fundamentals associated with the building.
It is your willingness to pay and your agreement to pay the highest agreed upon price.
Yes. And it's a lot about perception.
Wildly irrational.
It's wildly irrational. A lot of it is driven by perception and sentiment around the neighborhood, school system, whatever else goes into buying a home. And the housing market, very similarly to other markets, shows signs of being overvalued, meaning that the high prices that we saw a few years ago was driven by low interest rates and higher demand, right? It wasn't because that house was fundamentally worth more. It's just that we created this demand, which increased the prices. And that's why printing money was so controversial, right? That's why people disagreed with the way that the US handled the global crisis and lowered interest rates and printed more money, because there was so much more circulating that it increased the demand for everything. And that's why we're in the situation now with these super high interest rates that Jerome ain't moving until we prove that we've learned our lesson, right? And this is also why market corrections exist and why we don't panic when they happen. They're either going to come top down, either from a government order or a higher interest rate, or they're going to come bottom up where people are just like, you know what, I'm kind of tired of paying $18 for a hamburger, or I would like my groceries to be under $150 again, right? This time I'm a little bit hopeful that it's both. It's both top down and bottom up, that consumers are finally sick of it and our government is holding fast and saying like, I'm not quite ready to lower them.
Yeah, I think, it's a willingness to say, let's rely a little bit more on this solid core fundamentals of what makes an economy healthy or what makes a company healthy. Or in this case, you're talking about a home. It's like, well, all right, there's always that point where it's like, okay, I mean, it's a nice house and it's a nice neighborhood, but like there is a point where it's like, I don't know if I'm willing to pay that much. You know what I mean? And so I think that's a great way or great, example to kind of help people better understand it, where it is very subjective. Doesn't mean that there's not going to be someone who comes in and snatches it up. Because
I was just about to say,
you're down here in Atlanta, and you just left your company, or you're moving from, let's say, New York or San Francisco, where you know exactly how hard it is to find a home, like your willingness to pay for that thing, right? But that can create a bit of an illusion for other people, or it might create a little bit of a spike or something like that. And so it's always important to, look at those things, but you also want to make sure that you're looking at the core fundamentals of that let's just stick with the house, like the core fundamentals of what is determining the price of that home. So like, how long has it been on the market, right? That's always been a really great indicator. Comparable home sales, right? Like another, just making it up, 4-bedroom, 3-bathroom house in that area with comparable square footage and finishes, right? Went for XYZ. How does that compare to what you're doing? And when you're talking about a company, it's going to be like, all right, well, what are other, just making it up, car manufacturers who have similar products doing, or AI chip manufacturers doing, or, you know, whatever it is, right? There's always going to be some other company that you can use to compare apples to apples and then use that to inform your decision. I think another thing is just going to be perspective from an insider to some degree, right? So you're going to ask your real estate agent. They're going to give you some perspective and some insight, but you also, to your point, have to be mindful of their incentives. Same thing with a financial advisor. If you call your financial advisor because you've been watching the news and you say, hey, man, like, I just want to know what's, just checking in, want to see
Right.
what's going on. Don't be surprised if they make a recommendation, because they know that you're motivated right now. And so if they make a certain recommendation, it is, and I would say they are justified to say, look, man, if you're so concerned based on what's happening, here are some of the things that you can do, right? Like I would do that too if I were a financial advisor. I'm here to help. If you're freaking out based on what you're seeing, then here's what I would recommend that we do. I don't know that we can necessarily be surprised if there's an, you know, incentive for them to make a certain recommendation, because that's the game that you're playing.
But you also have to remember to go back to them when you're not freaking out and say, turn it back up.
Okay, right.
Because what happened with my friend is he did exactly that.
Yeah.
He
got scared and
got
then ended up
scared
with a
and
giant bond portfolio for
yes,
missed the
missed
entire.
all of 2023,
It's
all of
crazy.
2024, just stuck with it because in 2022 or whatever, he wrote that email. And it's like, and that advisor didn't proactively be like, all right, well, now we can be a little more aggressive. So
Yeah.
this is why, again, this is why you have to decide what you believe as an investor. And for us, it is this dance between data and intuition. Going back to your point about the house, you got to realize that you are not the market's reference point.
No.
You are one blip in the market.
Nor is your industry or your company or your city. Like, you see that all the time. People, you know, basing it off of what they saw between going to work and home.
Correct.
It's like, that is a very, very, very narrow way of like forming a perspective on pretty much anything.
On anything. And so there are a couple of metrics that you can look at. If we're talking about individual stocks, if you want to do a quant nerd assessment, you already own some individual stocks and you're trying to decide whether it's time to get in or get out or shift that money over to something more diversified. There are a couple of metrics that you can look at. The first one is the price to earnings ratio, also called the PE ratio.
Yep.
A high PE ratio means that investors are paying a lot for each dollar of earnings that a company generates. This might suggest that the company is overly optimistic about the future growth, or at least the market believes that they're overly optimistic.
Yep.
You could also look at their PEG ratio, which is price to earnings growth ratio, which takes the PE ratio and then considers what the company suggests their future growth prospects are. There's book value, which compares the stock's price to the company's asset. You could look at dividend yield, which tells you how much you're earning in dividend versus the stock price. But it's very similar to buying a used car. You can check the mileage, the engine, the safety ratings, the blue book, all of the numbers, but then you still got to do that gut check to say, does this feel right? Like, do I really believe that this is going to be a good purchase, right? Because it's still an asset. And it's depending on the decisions that you make, depends on what future you have with that thing.
Yeah, as a mature investor, I would also add to that, you know, some of the softer. It is a quantitative measure, but, you know, I feel it feels like a qualitative one to me, which is to look at any CEO or executive movement with their shares, right? Like, what are they doing with the stocks that they own? That's always, I think, a really key indicator. And again, I'm going to pub it again, but we talk about the role that the CEO, as the head, as the leader, as the face of a company, plays in the attractiveness of a particular stock. We have sat in on many an earnings call. We have sat in on many a corporate call, and you see the performance of it all. And so over time, I think as you become a more experienced investor and you're paying attention to these things, you just get better able to determine what is smoke and mirrors,
Mm-hmm.
what is actually real and worthy of reacting to, what might be a waste of time. Yeah, all of those things. I think that's the first thing as we were going down some of the indicators. The other thing I would add to that is figuring out whether or not these are leading or lagging indicators. So is this like a snapshot of what happened in the past, or is this a bit of, an indicator of what they are projecting might be happening in the future? You might
Mm-hmm.
also want to look at those indicators. Let's say we're talking specifically about the PE ratio. What has that been over time? And so how has that tracked? How was it this time last year, before the announcement of the release of these things, or before the announcement of the government, or before the election? And that set the tone for what the future, outcome of that industry might be. Let's
Mm-hmm.
say it's oil and gas versus something that's a bit more climate friendly, et cetera. So all of those things I think play a role in that determination. But you just have to keep in mind, right? Because you can run into you can start to see how you just run into analysis paralysis
Mm-hmm.
very quickly. And as much as we're encouraging people to make these decisions on their own, we also know that that can lead to like overwhelm. And then at the end of the day, people just relying on their gut. And so part of this, I just think, is part of the experience. It's very similar to dating, right? Like I can tell you what to look for, but like you still have to go out on that date. You still got to feel like the energy from that person. You also have to assume and hopefully be honest about the energy that you're giving off, because you're making a big decision about where you're going to place your bet or your money into a particular company. And hopefully it's not, too much of it, right? We still represent, or still recommend rather, a disproportionate share of that money should be in diversified mutual funds, not like individual stocks. So let's still keep it below 10%, I would say,
Yes.
for most people. And in fact, for most, I would say maybe even a little lower, but that's up to you.
Yeah. At the end of the day, any individual stock price is going to be a moving target. You can either drive yourself crazy trying to predict every single move, listen to every single conference call, watch all of their leadership changes on LinkedIn. You drive yourself crazy thinking that the world revolves around this one company that you happen to own some shares of. Or you can develop a strategy that puts your behavior, the thing that you control, at the center of your success.
Yeah.
And to me, that's what index funds do. Index funds is what allows us to not get caught up in any single company's performance. You know that you own the top 500 stocks in the country and that thing is self-cleansing, as J.L. Collins says. When something goes wrong, when one of them loses their way, it just gets dropped and replaced with somebody who's a little more, on it. So it's just not something that you have to worry about.
Yeah, and I would say that's especially true if you work for the company. That was something that I remember. I never fell victim to it, but I remember there were people that I worked with at our last employer, and they were individual stockholders, and you could just tell they were very old school in their perspective. They thought that was a good thing, and they would use the company information to influence whether or not they would buy it. I was like, well, you don't get the news from this company. The company is always going to tell you that things are going good.
Oh, yeah.
Like they're not going to say, "Hey, man," unless things are like absolutely brutal, they're not going to be upfront about it, and they can't hide it. But yeah, in fact, it was almost a little game for me. I was like, all right, this is what the internal news says, and I'll go on to Yahoo Finance and see what they're actually
What the
saying.
analysts say.
Exactly, which
Yeah.
is like, yeah, it's done. You don't want to buy the stock. So yeah, I think we've said it a couple of different ways, several different times throughout this episode, but I think for the vast majority of people, whenever these moments happen, like unless we are legitimately talking about a recession or a depression, I would say rarely do you ever have to make a decision. Even when we're talking about like owning an individual stock, let's say you've got 2.5%, I'm just making it up, of your portfolio in an individual stock, and there's some type of hiccup, which is what I would call what we experienced the other day. Don't know that you need to do anything.
Right.
Especially if that's like in your 401k. Like I could understand if it's in a taxable account and you have, let's say, like a midlife purpose for that particular money, and you're particularly sensitive to the fluctuations because that might have an impact on your ability to use it. But if it's in your portfolio that is designed for long-term growth, like you don't need to be doing anything,
Yeah.
right? Like you just keep doing what you're doing, focus on what you can actually control, which is the number of the frequency of contributions that you can make into that particular account or any set of accounts. That's what you control. you have banked in or understood the level of risk that you've assumed with these types of decisions, and you just keep it pushing, right? Do yourself a favor and focus on the things that you can actually control and not fall victim to the hype.
Yes. Things you can control, your diversification. We do that through index funds, but we also have a mix of international, domestic. We have a little bit like a sprinkle of bonds. We have sector indexes in certain accounts like our HSA and our 529. And most importantly, we've always had income producing assets as an additional safety net. And maybe we'll do a separate episode on this. But there was a time where we had real estate that was generating a little bit of excess from rent payments. We've had our business. We've just always had some level of an income producing asset to help offset the low periods in our traditional assets. Going back to Julian's point around dollar cost averaging, which is the fancy term for investing at regular intervals.
Right. That's what it's called. That's what I was referring to. I didn't actually use the term. I think I was trying to be sensitive to too much vocabulary. Every time I use some term that requires explanation, I feel like I've got to derail and explain everything, which is part of the challenges of having these kinds of financial conversations, because you can't talk about stock over valuations without talking about what is a stock, what is a valuation, and how does that differ from this? And then before you know it, it's like, all right, you've lost people.
Yes.
So, but if we have lost you, that's what the class is for.
Exactly.
Right? Because we break it down. And so like we've taken the time to actually structure those conversations in that master class. So if you're out there, you're listening, you're intrigued, but still a little bit confused, Making Money Grow is still available. It's our master class on investing. We teach you everything you need to know in 5 hours. It's self-paced.
And you can develop your own strategy. I'm not out here trying to tell you what to do with your money. I'm trying to help you think clearly about what you want to do.
It's about confidence, right? It's about giving you the confidence that you need to, in many cases, not do anything, not overreact, but know when to react, know how to plan for retirement, know how to structure your investments, know how to make decisions confidently. Because I've been there. Like I've been there making that decision, and you're doing it because you know you're supposed to be doing, but you're not really confident in what you're doing. It's a very sick, twisted kind of feeling. And so this is really about like turning that into no different than what you want for dinner tonight.
That's
you know, you know what we eat. So
that's it.
This is what's on the menu. You know what restaurants live around here. Don't ask me again. Like this is what we do. This is what we eat. Keep it pushing.
All right. I love it. All right, y'all. Well, thank you for listening to another episode of the Rich and Regular podcast. This is the one time where I am going to tell you what to do, because if you like what you heard, let us know. Leave us a 5-star rating and review on your favorite podcast platform, or drop a comment below and we'll keep the conversation going. We will see y'all next week.
Couldn't get an overvaluation joke.
I tried, but my brain wasn't. It's still on Bourbon Street. If you like videos like this and want to see more, make sure you click subscribe and turn on notifications.